Welcome to another edition of TM3 Impact. I am with John Hudson with H&M Mortgage. John, you're back.
Yes, it's good to be back.
It's good.
A lot's happened since the last time I was here.
Let's recap, because I think we need to go back to, what was it, 2020?
Back in time, yes.
This would have been 2020.
Right when COVID started.
Yeah. Yeah, so you made some predictions on that pretty much every one of them hit. You were like the Nostradamus of the loan market at that point. So let's recap that a little bit.
Yeah, so when COVID hit, right? Everybody, and I remember it specifically because it was like 2 days after the Fed cut rates to zero. Do you remember that? And then everybody in the world was like, "Oh my God, mortgage rates are zero." And then everybody in the mortgage industry had to go, "No, mortgage rates are not zero." But they are getting better.
Yeah.
And mortgage rates did get better. And what was happening back then was the Federal Reserve Board, as an emergency measure, was going to purchase mortgage-backed securities, which artificially brought down mortgage rates for everybody. Right. But what we were talking about was that, hey, this is going to create complete madness in an interesting way, because it's going to bum rush the market. We're going to see home prices shoot through the roof, and we're going to see everybody and their mother come out and try and buy a house. And that's exactly what happened.
That's exactly what happened.
And then what we also talked about, though, was that it's going to create problems in the long run, because now we're going to have an inventory shortage. And then at some point in time, the magic money was going to run out, and it did. And inflation kicked in, and mortgage rates shot from 3% to 7% overnight.
Literally.
And then then the whole market just broke.
Yeah. And
that's why 2022, 2023, 2024, have been 3 really tough years. So we had 3 amazing years, and then 3 really tough years for the real estate and housing finance industry.
Yeah. And so coming out of that now, now we're going into 2026.
Yeah.
We got a lot on the table to talk about, because we got rates are down to under 6.
Yes and no.
Yes and no.
Right?
Okay, fair.
Right.
So share that. Where are rates at roughly for the average client?
It's tough to say, right? Because there really is no average client, and I don't mean to say that in jest, but you could say that national average statistically, right? Mortgage rates are on a 30-year fixed rate, assuming 740 credit score and putting 20% down, are roughly 6.3% today.
Okay.
However, right, there's still ample room for consumers to get rates still in the 5 handle.
Okay.
And then of course, what kind of loan program are you doing? Are you doing a conventional loan? Are you doing FHA? Are you doing VA? Are you doing USDA? So bottom line is mortgage rates are down to the best rates that they've been in about a year. Okay. Yeah. That's good. So yes.
That's good news.
Now, and subsequently with that though, right, we're also seeing more people come out of the woodwork.
Yeah.
So
for sure.
I've got a great little one-liner for that.
Yeah.
When rates drop, home buyers pop.
Oh, I like that.
Right?
I like that. That's good.
And it is. Just picture the meerkats. Right? Their little heads pop up like, hey, mortgage rates are better.
Yeah.
And one of the slides I've got would kind of backs that up.
You said when rates drop,
home buyers pop.
Home buyers pop. That's so good. I love that, man. I love that. Now, okay, we gotta address this, because I think this is really important, and help people understand just the idea of mortgage, getting a mortgage broker, bank, working with a banker. What are the key differences in terms of what that means for the person that's looking to get a loan, or someone that's looking to refinance? Right.
Well, let me just back up just a hair. So I've been doing this now for almost 28 years.
Yeah.
Right. Got in the business in 1998 as an intern, and have literally done just about everything in mortgage since then. But it was just almost 2 years ago that quitting sounds terrible.
No, I wasn't quitting.
Because I'm not a quitter.
No.
I was evolving into the next step.
Yeah.
And so I resigned my post as an executive VP for a multi-billion-dollar a year mortgage banker. Where I was managing the wholesale division, working with mortgage brokers.
Yeah.
And I decided to go start my own firm.
Yeah.
And that was how we started H&M Mortgage. But so we did open up as a mortgage brokerage firm.
Okay.
And the reason for that, in my opinion, is that a mortgage brokerage today has, shall we say, a bigger box
Okay.
for consumers.
And by box, you mean options of tools, like
Options,
different
tools.
types of
Yes.
loans, would you say?
Yes.
Okay.
Different loans,
Yeah.
different rates. And so when a traditional mortgage banker, right, they're putting out their own mortgage rates for the day. They have their own specific set of underwriting guidelines that they're going to put out there for the day. Me as an independent mortgage broker, for example, I have access to over 25 investors, 25 other mortgage companies that I can do business with.
Okay.
So I have, and every mortgage company is different in that they all have different layers of risk that they're willing to accept.
Yeah.
And with that too, I've got 20 different sets of mortgage rates to look at every day. So we do have the ability to give consumers what I would say lower interest rate options
Yeah.
versus a traditional mortgage banker. Now, some would say that there's pros and cons to each. Absolutely.
Yeah.
Some would say, well, the mortgage banker has more control, right? And I would say that, well, to a certain degree, yeah, because in theory, it's only that mortgage banker's employees touching the loan.
Yeah.
But here, it doesn't matter because today what I'm trying to deliver is a customer experience.
Yeah.
And what the customer experience is, it's the whole show.
Yeah.
So, and then the third point is why consumers can possibly get a better deal than versus a retail or a traditional mortgage banker is, ironically enough, mortgage brokerages are capped on their total gross revenue.
Oh.
So the maximum a mortgage broker can make per loan is only 275 basis points
Okay.
to the firm,
Okay.
right? Versus traditional retail mortgage banker, they can have whatever margins they want in that loan.
Oh, interesting. Okay.
So there is data that's out there to back that up, that
Okay.
consumers on average, and this was from the 2022 or 2023 HMDA statistics, showed that consumers on average saved about $12,000 when working with a mortgage broker versus a mortgage banker.
Interesting. That's
And
interesting.
So it is fascinating. What it does is it forces you as a small business to operate with extremely tight margins.
Yeah, for sure.
But again, today the consumer is smarter as well. They're shopping a lot more.
They're shopping.
And
Yes.
I mean, you see that just even in the use of ChatGTP amongst millennials and Gen Zers now.
Yeah.
35% are using ChatGTP to help them buy a house.
Yeah.
So in essence, and I think this goes back to whether you're selling real estate or selling mortgages, what we do is become a commodity.
Yeah. Well, for sure.
And so that's where, I really think you have to kind of separate the difference between customer service versus customer experience.
Yeah. Yeah, that's good. It's kind of like what we were talking about on the mastermind. I asked, and I'm going to ask you this. What does the term luxury mean to you when you hear that word luxury?
When I hear luxury,
what does that mean to you?
Hand holding.
Oh, okay.
And I say that, right? So my family and I, we just got back from Disney World.
Okay.
Right. And so it is the experience. It's the, are you shopping at Nordstrom's?
Yeah.
Or Walmart? Not to knock either one.
Yeah.
I'm just saying
they all have their purpose.
It's going to be a different experience, right? You're going to go to Nordstrom's. You're going to be handheld throughout the process. Yeah. Walmart, go get what you need to, bring it up here and check yourself out.
Yeah.
We went to Disney World last week.
Okay.
Everything's the show. Yeah. I mean, so depending on what hotel, it really doesn't even matter what hotel you're at. You walk in the park, it's luxury.
Yeah.
Because you're being handheld. You're seeing, you're part of the show.
Yeah. Now, did you do the whole concierge?
No.
No?
We didn't do that.
Did you do the fast pass and the whole
absolutely.
thing?
Okay, lightning lanes for sure.
Yeah, lightning lanes, all that. Okay, got it. So you had somebody help you with that. Because that could be a whole strategy.
Oh, absolutely it is. And yes, and for what it's worth, anyone that wants, I do have a travel Disney planner person that is awesome.
Okay.
We've now been 4 times in the last 4 years.
Oh, wow.
Yeah.
Yeah. Star Wars?
Oh, for sure.
It's the best.
For sure. Guardians of the Galaxy, amazing.
Yeah, I love Guardians of the Galaxy, that ride. But when I saw that Millennium Falcon, I think I turned like 6 again.
Yes, totally.
I turned like 6 years old. And I'm just like,
100%.
This is the coolest thing ever.
But think about that though, right? It's the experience.
Oh, yeah.
And so that is what I think of when I hear the word luxury. It's going to Disney and becoming a 6-year-old again.
Yeah.
It's having a concierge level experience that's going to walk you through every bit of the process.
Yes.
Yeah. I mean, the term luxury is coined, right? We just think of $1 million homes with that.
Yeah.
But I mean, it could be a $150,000 luxury cottage.
Yeah. Yeah. Well, and this is the interesting thing. What I said is in the webinar today, we were talking about the idea that, luxury is not a price point.
Right.
I think we get fixated because of $1 Million Listing, because of all these shows, Selling Manhattan. I don't know if you've seen that show, Ryan Serhant.
Yeah. Oh yeah.
It's a great show. I mean, all those shows are they're great in depicting the luxury in terms of like super expensive, right?
Yes.
But I think that when agents finally realize in business, let's just say business owners, because agents are business owners.
Yeah, 100%.
They're business owners, right?
You eat what you kill.
And you're a business owner.
Yeah.
So for business owners, understanding that it's not a price point, but luxury is the standard. It's the way, it's the experience that we give. Yep. It's that process that we walk them through to get them to that end result. That's luxury.
Yeah.
And so now with that, so here let's just talk about the hottest topic. I think the hottest topic is the 50-year mortgage, right? Like we just got to bring it up. You know what I mean?
Yeah. No. Yeah.
So I sat in bed. It was so funny because I literally was like, ChatGPT. Okay. And you know how you could talk to it, like have a conversation? Have you done that yet?
I still haven't done that yet.
Let me show you. This is amazing.
I still haven't done it.
And we got to show everybody this. So I'm gonna show my screen here. This is really important for those of you. If you want to take ChatGPT to a whole nother level, I want to show you just how crazy this next layer of ChatGPT is the audio. So I'm going to go into my clone. I have a clone of myself where I have all of my different, things in here. And so let's just go to, we're going to, I'm going to add another one here. And so what do we want to talk to her about? 50-year mortgage?
Ask.
Okay. This is so good.
Well, what's your chat's name?
I don't know what her name is. Yeah, that's a good question. Hello, what's your name?
I'm not actually a person with a name, just your clone co-pilot here to help you out. You can just call me whatever you like. Let's keep things rolling.
Interesting.
Okay, well, I want to call you Julie. Will you be Julie from now on?
Absolutely. You can call me Julie. I'll happily go by that from here on out.
Okay, Julie, I'm with my really good friend John Hudson, and I've got to know, the 50-year mortgage. They've been talking all about it with lending. He's a lender, a mortgage broker, and I'm really curious. What do you think is the true advantage of a 50-year mortgage, and what are the disadvantage of a 50-year mortgage? And just put a dollar amount on a $500,000 house.
Absolutely, Thomas. So Julie here to dive into that. So if we're talking about a 50-year mortgage on, say, a $500,000 home, the big advantage is obviously that your monthly payments are going to be lower compared to a 30-year or even a 15-year mortgage, just because you're spreading it out over a much longer time. So the cash flow month to month is going to feel lighter. On the flip side, the disadvantage is you're going to pay a lot more interest over the life of the loan, because 50 years of interest is a long, long time. It's basically almost doubling the timeline of a standard 30-year mortgage. If we put some numbers to it, a $500,000 home with a 50-year mortgage is going to have a lower monthly payment, but by the end, you're going to pay significantly more in total interest than you would if you just went for a shorter term loan.
And what would the total interest be at $500,000? Let's say current rate is what, John? What do you think? 6%?
Yeah, let's say 6%.
Like 6%. What would the total interest be on a 50-year mortgage compared to a 30-year mortgage?
Yeah, absolutely. Let's break that down. So if you're looking at a 50-year mortgage at about 6%, you'd be paying interest for that entire half century. Roughly speaking, on a $500,000 loan over 50 years, the total interest could be well over $1 million, sometimes even approaching 1.2 to 1.3 million, depending on the exact details. Now, if you compare that to a 30-year mortgage at the same 6%, you might be looking at something more in the range of, let's say, $550,000 to maybe $600,000 in total interest over those 30 years. So basically, you're paying a lot more interest with the 50-year just because you're stretching it out longer.
Yeah, and so Julie, so last question, would you say what are the percentage of people that actually live in their house right now according to all of the research, what's the average length that someone is living in their home right now?
Yeah, absolutely. So on average, if we look at the research kind of just across the board in the US, most people tend to live in their homes for about, I'd say 8 to 13 years.
I was going to say 11.
Yeah.
Oops.
Yeah,
Okay.
that's pretty spot on. So it's about that 8 to 11 year range on average that people actually stay put in a home before they move on. So definitely not 50 years.
No, nobody's living in their house. Julie, thank you. So here's the thing.
That's wild.
Okay, here's the thing.
Yeah.
You can literally do a prompt like that verbally. You could tell her everything that happened at an event. This happened. Let me read you my notes. Okay, now I want you to ask me questions about what I just told you and put all that information together in one paragraph.
That's awesome.
And Julie will do that.
It's like Jarvis from Iron Man.
Like Jarvis from Iron Man. Yeah. And you could change the voice. Now, Gronk does this as well in the Tesla. You can actually do this with Gronk. Be careful because there's an unhinged version.
Oh, wow.
And it's...
I can see Elon putting that in there.
it's literally Elon as a high school kid that just it's pretty ridiculous. It's pretty ridiculous. Okay, so we just learned from Chat GPT, right? Like we just learned basically Julie just told us like, yeah, you're gonna be paying like almost what did it 1.2 million in interest?
Right. And so this is where I'm gonna like also kind of pop some other people's bubbles that are promoting the 50-year mortgage. First of all, you're not going to have a 30-year fixed mortgage rate that's the same as a 50-year term.
Okay.
Right? So you're going to be paying 7% for that. So the gap in payment
I didn't
is going
think
to be
about
even
that.
lower. Right, because actually as of today, the law actually states that a qualified mortgage, I should say, cannot exceed the 30 years in term.
Okay.
So that would make it what's called a non-QM loan, which means that you're not going to get market best interest rates for that.
Right.
So that's going to even shorten the gap between your payment savings.
Yeah. Because 1%, you don't think it adds up, but that adds up. That 1%.
Oh hell yeah, it does.
Big time.
The biggest problem, and regardless of what administration is in power, they're trying to just solve everything with things that would in generally fix demand. We don't need to fix demand. There's so much pent up demand out there. It's not even funny.
It's true.
What we need to still fix is the supply side. So what think about this, right? As cars have gotten more expensive, what's happened? Auto financing terms have gotten longer.
True.
And ultimately, all that's doing is ultimately increasing the cost of said car.
Yeah.
Because, now I can just extend it out to a 10-year term. So, let's buy the $60,000 car because now the payment's the same as a $30,000 car.
Please tell me they're not doing 10 years.
There are 10-year loans out there.
For cars?
Yes. Now,
holy cow.
Now they're rare.
Yeah.
But I did see that number one, the average cost of a new car today is roughly $45,000.
It's just nuts.
But now more than 20% of auto financing is now at 84 months. 20%, so 1 out of 5, 7 years.
Wow.
We talk about people being in a house for 8.
Yeah.
So we're not fixing the problems, which are affordability.
Yeah.
And all these things factor in there. People's budgets, financial literacy. So I struggle with wanting a 50-year mortgage out there because, it'll ease some of the payment burden, but it's only going to be picked up somewhere else. And the other struggle that you have there, and this is what I would challenge real estate professionals that have thought of the idea, this could be good.
Yeah.
Well, if people are going to be in their house for 10 years, well, then they're going to have to sell their house.
Yep.
Well, if they've only been paying interest for 10 years, you're expecting, you better be expecting that house is appreciated enough to cover the commissions that it's going to cost to offload that property.
Right. Because you haven't paid enough principal at that point. There's not enough principal. It's almost all interest.
Right. So now they've got to be in the house for 15, 16 years to not be underwater and not bring a check to closing when they sell it.
Yeah.
And so I think that's just one of the talking points that doesn't get talked about enough.
That's good.
Now, what I will throw out there is, and I give the current the Trump administration, credit. I mean, they are great carnival barkers. They know how to drive up conversation.
It's true.
And what I am glad, though, is that to a certain degree, affordability is now a conversation that's out there in the general population.
Good.
So, that may not be the best idea or way to solve the problems that we have, but at least it's begun the conversation of affordability, which is real. Now, if I wanted to solve affordability issues today, my idea would be to, dare I say it, but you're going to have to incentivize home builders to build inventory in what I would deem an affordable range, which would be anywhere from $200 to $350.
Yeah, that's the rub.
That's
the rub.
That's the sticky part, right? I mean, builders want to sell $500,000 homes because that's where they get their margin.
Yeah.
But really what the consumer needs, particularly in like San Antonio, with our median income being lower, we need that $200 to $350.
Yeah.
And so how are you going to incentivize them to do that? It's the little single story boxes, that's not what people are going to buy.
Right.
I'm talking like a quality home in that price range. You're going to have to incentivize
I don't even know if
tax
it's
credit.
possible. So you're right. They're either going to have to incentivize the builders by subsidizing it.
Yeah. I mean, that's what a tax credit
right?
would be. Yeah.
They're either going to subsidize it, or other than the government subsidizing it, I don't know how you make that work. That's tough.
It's very tough, right? Because of all the inflation that we've had over the last 5 years, right? Materials are up, labor's up. It is a real challenge.
Yeah. Yeah, interesting. All right, you brought some charts.
Yes,
let's talk.
I did bring some charts.
Now, for those of you, here's the thing. John does a chart of the day every Friday. It's every Friday, right?
Chart of the week. Yep.
So chart of the week, make sure you tune in on his social. What's your social?
Well, at JHP Hudson on Instagram.
Okay,
so at
there you go.
JHP Hudson.
And does it share on Facebook too, right?
Yep, Facebook
so
too.
On both, you'll be able to see it there.
LinkedIn, X, TikTok even.
There you go. Smart.
Yes.
I just started.
Yes.
I just started.
That's where the millennials and Gen Zers are. So.
Yeah, we need to be more on the talk ticks. All right. So what's this one? Tell me about this one.
I brought some fun charts, and
I love it.
And we'll speed through some of them.
Yeah.
So the question I get the most is, what's your rate?
Yeah.
It's the number one question any mortgage person gets. What's your rate?
Yes.
And again, I can give you a range. I don't like to quote anybody rates, right? I want them to have options. But considering yesterday, what happened?
I don't know.
Federal Reserve cut rates.
Yesterday?
Yes.
I didn't hear this.
Yeah. Federal funds rate is now down to 3.75.
And what was it?
4%. So they dropped it another quarter.
Okay.
Now, that doesn't mean mortgage rates are 3.75.
Right.
Everything that mortgage rates are built are decided based on the appetite for mortgage-backed securities.
People buying those securities.
Right. And I'm sorry, there's no easy 30-second sexy soundbite to float out there. How do mortgage rates start? But what this chart shows us, this is the 5% coupon mortgage-backed security for 30-year fixed-rate loans. Okay. This is the primary chart that the investors are buying. Okay. And the people that are buying these, governments, insurance, hedge funds, I mean, you're not having stock pickers on Robinhood going and buying mortgage-backed securities, right? These are major institutional funds. But what we see here is you can see that where red is bad, green is good. Okay. And you can see all the red here, and this is the last 5 days, mind you, right? Gosh. So if you go back to December 5th, like mortgage rates, when it's when the price is coming down, that means mortgage rates are going up. Okay. So we see yesterday, or December 9th, mortgage rates were the highest they've been in 5 days. Okay. Fed cuts rates. That didn't really move the market. What moved the market was the commentary from Fed Reserve Chair Powell talking about instability in the labor markets. Right? Jobless claims. Okay. Higher unemployment. That signifies a slower economy. Yeah. When a slower economy is out there, more folks are the safe haven investors are going to buy longer fixed income securities. Okay. So that's why we see this little rally here, right, where rates are getting better. Green is good. Yeah. So because what the Fed did by saying that, they're signifying that we're going to have more rate cuts in the future as the labor market continues to be unstable.
Was that right at the point that he Literally.
started talking. Yeah, like
He's-
right here.
and
Right
then
here's where
boom.
he started talking. Shut up.
Wow.
So this is the last 5 days.
Interesting.
Go to the next chart.
Okay.
This is the last. Let's see here. This is the last month.
Okay.
And so, and I put this out there, right, just so people can see that rates are all over the place. They change constantly.
Yeah.
So you can see here that for the most part, rates today are only slightly better than they were a month ago.
Okay.
But since then, they got higher, then they got lower, then they got higher again, now they got lower. Now go to the next one. This is 3 months. You see this kind of pattern
Yeah.
up and down, up and down.
What's
up
the
and
red,
down.
blue, a red, yellow, and the red and blue and green? What are those different?
So, these are those are different, basically different securities.
Indicators?
Yes, different securities in there. But the main bar chart that you want to be looking at, right, is strictly just the red and the green.
Okay.
Like the candlesticks.
Yep.
And then go to the next one, and we see that over the last year. So, where I'm going with this is mortgage rates today are the best they've been in a year.
Okay.
And because of that, more buyers are when rates drop,
Yeah.
home buyers pop.
Yeah.
And so that's why we're seeing the market overall get better today with more interest from home buyers out there. But you can see, right? I mean, so when you go to the 3-month chart, you see up, down, up, down,
Yeah.
up, down.
Yeah.
But when you take the timeline out, you can see, oh man, rates are slowly getting better.
Yeah. Yeah.
You know,
That's good.
So it's good for people to see because again, no one talks about it.
Yeah.
Consumers, they just hear, or even sophisticated people, they just hear the radio or TV. Oh, mortgage rates today are X, Y, and Z, or the Fed cut rates. It's like no, there's a lot more into it. There's how much are you putting down? What kind of loan program are you doing? What's your credit score? What's your debt to income ratio? Can we verify your income or not? You know,
Right.
all these things factor in there.
Right.
And so just know that overall today,
Yeah.
you're getting a better deal than you would have a year ago.
Okay. That's good. That's good.
So now,
That's good news.
yeah, it's great news.
Now, what do you think is is there a possibility that he could lower it again?
Yes, I think the Fed could continue to lower it again, but
I know that doesn't necessarily indicate.
that could also spook bond investors too. And so in theory, mortgage rates could go up. Why? Because think about this. Historically, when the Fed is cutting rates, they're trying to do two things: either stave off unemployment or stave off inflation. So inflation seems to have settled in. I mean, it's at roughly 3% right now, which is
That's good compared to where it was.
compared to where it was 9% just a couple of years ago.
Yeah.
But when you, it's still higher than the Fed mandate. But so if you're cutting rates, and let's say the labor market improves, and you're still cutting rates, well, now you're just adding. It's like pouring gasoline on the inflation fire. And that was what we had that caused the whole thing to break.
Got it.
So think about it. Stock market's at all-time highs. Gold's at all-time highs. Bitcoin's near all-time highs.
Yeah.
All the things are at all-time highs or near.
Yeah.
And now you're lowering rates when the economy seems to be doing good. But I would challenge that the economy looks great on paper, but the reality is consumers are tighter with their spending.
Well, so this will be an anecdotal story.
Yes.
Okay.
I love anecdotes.
So I was in Miami yesterday at Aventura Mall. Okay. The Aventura Mall is probably one of the nicest malls I've ever been to. It's up there. Probably Dubai. The Dubai Mall is probably better.
Wow.
But
Like Rodeo Drive type stuff? Just
it's even cooler than Rodeo Drive because all those stores are in that mall.
wow.
Okay.
Okay. Yeah.
And more. Like every brand that's that's on Rodeo Drive, all those stores are there. They have all those stores there. And then you have the other brands that are even more niche and even more luxury that my son's like, oh, that's a WW. And I'm like, I've never heard of WW, whatever that is.
Right, yeah.
And you go in and there's like 10 pieces of clothes and that's it. It's like all couture. And like, so that's the mall.
Yeah.
Brother, it was packed.
Yeah.
It was packed. Now I know it's holidays. I get it. But it was on Monday at 11.
Wow.
And it was packed.
Yeah.
So now I do realize this. Obviously, different areas are more, doing better, right? Financially, a bit, depending on where you're at, right? I do get that. But man, it just seems like, the only thing that I was kind of surprised about is the restaurants weren't as packed. The shopping was packed.
Yep.
but all the restaurants weren't packed.
Yeah.
So that's a tale. That's kind of a tale.
No, I mean, traditionally, right? I mean, restaurants are kind of canary in a coal mine for consumer spending.
Yes.
If you look at data just came out last week, right? I mean, and not financial related, but it was just like the number of people consuming alcohol is like at the lowest point it's been in 50 years.
Oh yeah.
So, and my thing is, people are saying, oh, people are just healthier. And I'm like, no, I think it's, people aren't going out to bars anymore. They're not going to pay $15 for drinks anymore. And, post-COVID, we just don't socialize like we used to either.
Not as much.
So all these things add up, but I still think cost is a big factor there. So here's some fun facts.
Yes.
So right now today, the top 1%, right, in this country owns 50% of all stock market wealth. So if you think the stock market has a 60 trillion market capitalization, that's 1%
owns 50?
owns $30 trillion worth of assets. Wow. Right. Now, there's obviously outliers, the Bezos, the Musk and whatnot. But
true. And they skew it because of that. Yeah, but yes.
So let's break it out even a little bit further, though. The top 10% control 90% of stock market wealth.
Wow. But how much of that is like the private equities, the Black Rocks?
Oh, yeah.
You know what I mean? Like
a big chunk of that. But you're still talking, the top 10% controlling 90% of stock market wealth.
Yeah. Yeah.
The bottom 50% of our country owns 1%.
Wow.
So that's why I kind of, giggle a little bit when I hear, bless his heart, our president, pray for him every day. But I giggle when I hear, oh, look, it's awesome for Americans. Their 401ks are the best they've ever been. Their stock market is all-time high. That's not helping the base.
Yeah.
That's not where that's coming from. And there is data that's out there that shows, right, that roughly 60% of consumer spending is still done by the top 20%.
Right.
So if you got money, you're still spending.
Yeah. Yeah.
Right. It's where's everybody else pulling back.
But there's more people that don't have the ability to spend.
Correct.
Right. There's more numbers that don't have that ability to spend.
Yes. Well, absolutely. Which is why the buy now, pay later is through the roof.
It's crazy.
And that's why, credit card debt is at all-time highs, according to state data from the Federal Reserve Board. So, coming out of post-COVID, you saw the savings rate drop. I mean, we're now saving less as a society than we were pre-COVID.
Yeah.
But meanwhile, credit card spending is continuing to go through the roof. So the challenge there is, how do you rein that in?
Yeah.
When does it come to a head? Plus now you've got student loans that are needing to be paid back. And I'm not trying to be all doom and gloom at all. I'm just saying that there's a great reset coming.
There's signals.
There's signals, and there's going to be a great reset coming. And I think overall it's going to be a good thing, because at some point consumers are going to have to reevaluate their spending habits.
Oh yeah.
I mean, self-included. I mean, everybody. Right? We're all looking at our budgets now and going, okay, how do we do this? And I don't care. I don't care what segment of the income or wealth ladder you are. You're looking at your numbers a little bit tighter than you did a couple years ago.
Yep, for sure. You have to.
Yeah.
Now, what is it? I heard a statistic about the number of homes that were in the steps of foreclosure in Bexar County. Have you heard that statistic? It was high.
It's yes and no, right?
Okay.
So yes, the delinquency rates.
There it is.
Yes,
delinquency
rates are up.
It's different.
It is different, and delinquency rates are up, say 10%, which sounds, oh my God, that's huge. But delinquency rates overall, again, you extract it out over time, have been so low for so long that it's not like there's a giant wave of foreclosures coming, but you are seeing an uptick.
Okay.
It's like when you go from 1 to 2, man, it's up 100%.
Yeah.
So the percentage wise makes it look worse than it is. It's going to sell more headlines. It's going to get more.
And
clicks.
that's what it did. When I saw it, I was like, it made it sound like there was a bunch more houses in foreclosure, but that's not really true. It's just delinquent.
It's right. So, but delinquencies are up overall, and that is again one of those little signals that people that are under more financial stress are ours is going to continue to see more trouble.
Yeah. All right, let's switch gears.
Yeah.
Because I think we know that the 50-year mortgage is probably not the best bet.
Long
right?
way around to get the
Right?
50-year mortgage.
I think we realize that. And so I want to switch this up and talk ultra marathon.
Yes.
Because you did your first ultra. Now, for those of you that don't know, an ultra is anything past 30 miles?
Well, past 26.
Anything past
Anything
36.
more than a marathon is.
Yeah, it's
is
considered.
right. But yeah, so now in the last 3 months, I've done 2 50Ks.
2 50Ks. All right, so let's, I mean, just for people to understand, that's 30 miles?
Yeah.
50K is 30
Muscle
miles?
Meadows, yeah.
Talk about that first one, because that first one looked rough.
Was super rough.
Yeah, talk about that.
You know, well, first of all, and let me just kind of go back. You know, so I've over the last few years, I've become obsessed with running.
Yeah.
And I hate running, but I love the way it makes me feel afterwards. And as I would just say a salesperson, right? You know, talking to my wife the other night, I said, babe, like at any given time, I've got 1,000 things running through my head. She goes, you're ADHD. I'm like, well, but that's no different than I was, I've just always been that way. I'm always thinking about business or clients or this or that. But when I'm running, that's like the only time when I really feel like I could just focus on one thing. Mm-hmm. And then, it's a great way to pound out the cortisol.
Yeah.
Right? Because, cortisol buildup is not good.
Yeah.
And get all those endorphins firing. So the runner's high is a real deal.
Yeah.
So that's why I go run a half marathon every Sunday.
Yeah.
Now with the dogs.
Yeah. Which is impressive that your dogs can run that far.
Well,
that's impressive.
Well, one's a Chihuahua healer mix.
Crazy.
Right? And the other one's an Aussie Shepherd. So the healer, he's pretty tired after 13 miles. The Aussie Shepherd's like, that's the warm-up.
Yeah. Like, they're like, run me some more.
Yeah. But so nonetheless, right? So I've now done 5 or 6 like full marathons.
5 or 6?
Yeah,
It's
been that long.
Wow.
Yeah. So
that's crazy, John. I didn't realize that many.
Well, think about this. I think the first full was 2019, and then they canceled it for COVID.
That's the time that my dad and I ran it. We ran the half,
Yes.
right? Yeah.
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 And
that would have been 21.
Was that 20?
It would have been 21. Yeah, that's when when we ran the half marathon together.
Okay, yeah. I remember seeing you guys. So and then because they had canceled 2020.
Yep.
Because of COVID.
Yep.
And then so 2019 was the first one. But yeah, so I've now done my 5th or 6th, and that was fun. But I randomly saw a thing called the Texas Outlaw Running, and it was like the coyote, the Desert Coyote Run, 50K. I was like, oh. Sounds awesome. Let me go check this out.
Yeah.
It'd be nice to be off the beaten path, just to try something different. I had no idea what I was getting myself into. And I was just thinking, oh, trail run. Yeah. You're just, instead of running on concrete, you're running on dirt.
Yeah.
No, this was up in Pedernales Falls. This was, running up on, up and down those big hills. And I learned the hard way. If you take your eyes off where the right foot or the left foot go, you're going to bite it.
How many times did you fall?
Couple.
Oh my God.
Scratched up, broke toes, fingernail or toenail came off. I mean, yeah, it was not good. But it was.
Oh my gosh.
It sounds terrible. But it was fun in the sense that you're not really timed per se. Now some of these guys, I mean, they're 20-something-year-olds, and they're they look like they're 150 pounds.
Yeah. They're
wet.
built like runners.
Yeah. I'm like.
Those dudes drive me nuts.
I'm almost 49. I'm weigh 186 pounds. I'm not setting any land speed records.
Right.
But there was something cool though about kind of like being lost in the wilderness by myself, trying to look ahead to try and find a little flag to tell me that I'm going the right direction or not. And so in all of that,
I'm out.
You would not have appreciated the number of ankle rolls
that
were out there.
And I've got bad ankles. I rolled my ankle running, I think it was back in June.
Yeah.
I rolled it while I was training for that Ironman. Right. And that one roll took almost 6-7 months. Like, you asked me to do that race, and I'm like, I can't do uneven surfaces. Yeah. Because it hurts. It still hurt.
No. It was. Yeah. So that was a super big challenge, but it did kind of remind me ultimately of like the home buying process, or mortgages or real estate, or just being an entrepreneur in general. It's no matter what, there's going to be ups and downs. You're going to have moments where you're able to move fast, and moments where you have to go slow. You're going to lose a toenail here and there, but at the end of the day, though, you still accomplish something, and then you look back and go, "Holy cow, man! I did that."
Yeah.
So it was. it was fun. It took me almost 8 hours, the first one.
Okay.
The second one, it took me 7.5 hours.
Wow.
Now there is a 60K
Oh boy.
in February that I'm going
boy.
to sign up for.
Where?
Up in Bastrop.
Bastrop be interesting.
Yeah, and it's called the Cowboy Yeti, and 60K. And I'm like, you know what? How far can this go?
56?
Yeah.
No, it's 60.
So that would be 60K. So it's going to be 38 miles, probably around there.
38 miles?
Think about that. So 50K is 30 miles.
And then a 10K is 6.
Yeah.
So 36.
So 36 miles.
Oh my goodness. John.
So, hey, I'm not saying I'm ready for like David Goggins style 240
Listen,
miles, but there's something definitely, best way I described it to my wife, it was a complete mental and physical cleanse. Probably not unlike an Ironman.
Sure.
To where when you're done, you're just like, man, that was awesome.
Yeah.
So,
well, I mean, I don't know if I felt, after Ironman, I don't know if I felt awesome, but I think I felt relieved.
Okay.
There was like relief.
Yes.
Right?
Yes. There's that. Because, physically, you're just like, oh.
Yeah. Physically, you're just a wreck, right? You're just a wreck. But and you just did the San Antonio Marathon.
Just did the San Antonio Marathon.
And your PR?
Oh,
was this your best
this
marathon?
This was my best ever. I did 5 hours 14 minutes.
Let's go,
for
John.
5 hours 12 minutes, something like that.
That's awesome.
And I got to say this. I think doing those ultras helped me for that.
Oh, for sure.
Because that San Antonio course was awesome. I thought it was great. I mean, but I really definitely have a new appreciation for the elevation change in Alamos and Alamo Heights.
Oh, yeah.
Lots of hills.
Oh, yeah.
But I found that, on the hills, all the other folks doing the marathon were walking, and I'm just kind of putting along. Again, not going terribly fast, but just putting and able to just maintain my pace.
Well, I got to give a full credit to the San Antonio Sports Foundation.
Yes.
They sold it out, John.
Oh, okay.
I tried to sign up 2 weeks out.
Man, that's
And
awesome.
it was sold out. No half, no full, nothing.
It was insane.
So that's impressive for San Antonio.
Yes.
Because the rock and roll was not selling out anymore. So, which is, to me, it's like, that's really shocking that they couldn't sell it out.
Yeah.
And then the San Antonio, they grab it and they sell it out.
That was awesome.
It's cool.
So
it's great for the city.
I will say this, and this was really impressive too. Yes, and San Antonio, they did an amazing job. But in the past, there's the mark where it splits off, right? All the halves go
I
over
remember
here,
that
and then
mark.
and then you go into, and then it used to be like no man's land.
Yes.
When you go, you go off to the marathon course, and then you look around, you're like, where did everybody go?
Well, it took you down to the river. I remember it broke off at the Alamo Dome.
Yep.
And you took the right there to go underneath the bridge, and then you went left, and you kind of went down by the Riverwalk on the south. Did they didn't do that this year?
No, they didn't. So
okay.
So in fact, the course it kind of meandered around there, and then you went back around by the golf course, and then back down towards into Alamos Park, and then you came up the dam, and then went through Alamo Heights and whatnot. So it was really pretty cool.
That's a totally different route.
Yes, no, it was totally.
So
different.
no Riverwalk.
No.
I kind of like that.
No, that's what I'm saying. It was a great.
Yeah,
it was
I kind of like that.
It was a really cool course. But I got to say that when it split off this time, there were a lot more full marathon runners.
You told me that.
I mean, it was busy, so I thought that was just really cool to see a lot more people, torturing themselves. I think my favorite sign I told my wife was there was a sign that I saw that said therapy would have been a cheaper option.
That's funny.
But it
That's
is.
funny.
I can completely tie it though to just in the industry that we're in, whether mortgage, real estate, because it's one step at a time. It's finding that way across the finish line without giving up.
Yeah. Yeah, so this kind of leads to, what Grant talked about. One of the things is when I was there at the coaching is Grant came in, and normally he does not go to the coaching mastermind.
I saw your video, and you're like, you're standing right in front of you.
Yeah,
that's pretty cool.
He was. I always like to sit up in the front because you never know who's going to show up at his office. So he showed up, and he was just talking about life, talking about everything, talking about his start. And then he shared a story about miracle moments. And he had this miracle moment where he was praying for a sign. And this is when he was like broke as a joke in Houston, Texas, trying to get his business off the ground, his speaking and coaching in the automotive. And he shared that moment. But one of the things that I love, that Grant preaches is that, look, it's not about getting to the destination. It's just don't stop.
Yes.
Just don't stop. Like, just dust yourself off, keep going.
Yep.
And one of the things that in my Ironman that I think I shared this with you. It took me 7 hours to do the marathon.
Yeah. No, you did tell me.
I told you that, right?
Yeah.
So for people that don't understand that, I did my marathon. My best PR was like 4:20, 4:27 or something like that.
I've run with you. You're fast.
And which is funny because I don't feel fast, right? I don't necessarily feel fast. Anyways, so I've run in the 4:20s, 4:30s, somewhere in there. For all you fact checkers out there, I know you're gonna look it up. It was in Las Vegas. That was my fastest one in Vegas. Super flat, by the way. Vegas is flat. Okay. Anyways, so the point being is that you just gotta keep going. But what happened in the Ironman is I got blisters.
Yep.
I got cramping. And I didn't have a way to stop the cramping. So if I tried to run, I would immediately cramp. And then if I walked too slow, I'd start. So I was in this limbo of and I just remembered, just finish. Just keep walking one foot in front of the other.
Yeah.
Don't quit. And I think that's a lesson anybody can learn is you're not out of it unless you actually stop.
Yep.
You're not out of it. So don't stop.
No, it's funny. So in the first ultra, it was mile 28.
Okay.
And I had that.
You had 2 miles to go?
I had that miracle moment. Or it was mile 27. It was like three or four. I had like 3 or 4 miles left. But it was it was starting at the bottom of one of those big hills all the way up, and it was a pretty steep incline too. And halfway through, I had to stop, and I had to sit down. And I had to contemplate life for a second.
You got lightheaded?
I got lightheaded, but I felt like everything was just breaking down.
Oh boy!
And I was like, and at this point, Darinka was texting me saying, hey, we're gonna be there in like 30 minutes. So I'm like, oh man, okay, I got to get up. And I tried.
Did you sit down?
Oh yeah. I sat down, but I couldn't really sit down because then everything started cramping up. Right. So then I had to be lay there in this awkward position, and I sat there. It seemed to me like it was like an hour, but it was probably more like 10 minutes.
Yeah.
And then finally, I just literally had to force myself to roll over. And
you were lying on your back or on your side, kind of sideways?
Well, I was kind of sideways and awkward because otherwise everything was cramping up. So I'm like this. So I kind of had to roll myself over and literally kind of do the right leg. Left leg.
Whoa.
Right leg. Left and just slowly but surely build up. And then you get to the top, praying it's not a false peak kind of thing, but get to the top. And then I was able to look down and go, all right, man, I did that. And then boom, second wave came. And then it's like, all right, let's finish this. But there was that moment you're talking about where total failure is seemingly imminent. Everything's breaking down. And you just got to get back up and go.
Just go. And this is for business owners. Ready? This is the analogy, right? For business owners, if you stay down too long,
you're not going to get back up.
You're not going to get back up.
Right.
So for business owners, if you've hit that wall and you're feeling stuck, you're feeling like, I don't even know how. Get up. Get up and keep moving. I can't stress that enough. I remember I was at about mile 16, 17 in the Ironman full, and I came around the corner, and there was a guy sitting down in a chair getting his feet taped up for blisters.
Ooh, yeah.
And I was like, I need to do that too. I need him to tape up my blisters. And as I'm walking, and I'm just in my mind going, okay, I'm going to sit down in the next. All right, I'm going to sit down. And the more and more I thought about it, the more and more I kept saying, I can't sit down. If I sit down, I'm done.
Yeah.
10 minutes later, golf cart goes by. That dude's in the back with his feet up.
DNF.
Didn't finish. He
Yeah.
quit. He just said, I'm done.
Yeah.
Because you stay down too long. So this is another reminder with Grant, okay? Targets. I'm going to share this with you. I shared this on the mastermind this morning on the webinar. I shared this on the webinar. We were challenged with a 30-day challenge, okay? Write your goals down every morning, every night, okay? Every morning, every night. And so I was like, all right, Grant. He said nobody can do it for 30 days, right? Nobody can do it for 30 days. Nobody can get up every morning, write it down, every night, write it down, every morning, write it down. He's like, you're not going to do it. He was right. I got home at 1 o'clock in the morning last night, and I totally forgot to write it down. He was totally right. I flew in, and I was like, crap, I forgot to write it, right? But this is the thing. When I was sitting in that room, and he's talking about his goals. Grant is 67 years old, okay?
I didn't realize he's that old.
He's got 15,000 apartment units.
Jeez.
He's got almost $5 billion in assets.
Wow.
He's got a company that's doing, I don't know how much, 150 million, whatever his coaching speaking. No, it's more than that. He's higher than that because just Cardone University does that, 150, 60 million, just Cardone University by itself.
wow.
Okay. So you sit there and you're watching this guy, and I was just like, I need bigger targets. I need bigger dreams. And you know what popped in my head? I want to be an owner of the San Antonio Spurs.
Ooh.
And it hit me like, what? Where did that come from?
Yeah.
Like, why did I write that down? And then it hit me. Why did that hit me? Why did that?
Yeah.
Because I need a target big enough. I need a target big enough
Yep.
so that I don't ever stay down long enough for any setback.
Yes.
Because I got a target that's saying, hey, if you want to. So then I I literally did Chat GPT. I said, I want to know every NBA owner and what did they do to buy a team.
Yeah.
So I literally have this whole thing written out, and I'm going to start doing stories about every NBA owner and what did they do to get the money to buy an NBA team.
Oh, that's awesome.
And then I want to start interviewing some of them.
Yeah.
Like, can you imagine if I was able to interview 10 of the NBA owners?
Oh, that'd be awesome.
And had these conversations about how did they do their business? How did they get to that point? And why? Why did they buy, the Spurs, the Holt family? So anyways, that was the journey. But you need a target big enough.
Well, that's what I was just going to say. I mean, that's like, right. That's going back to his core 10X rule, right? I mean, even if your target's 10, even if you do 2, well, you're still a lot better than you were today.
Yeah.
So yeah, I love the Les Brown quote, right? I mean, shoot for the stars, or shoot for the moon, because even if you miss, you'll be amongst the stars.
Yeah.
Right. I mean, so yeah, I'd totally buy into needing to have bigger targets because it's going to push you to do more than what you're doing today.
Way more.
And I got a quote written on my whiteboard in my office.
Yeah.
What you don't change, you choose.
Oh, that's good. Yeah. Yep.
So, if you're sitting there and, if you have mediocre goals, you're going to have mediocre results.
Yeah. That's so good. I love that. What you don't change, you choose. Yeah. If you're not willing to put in the effort to change, right, you're choosing. Yeah.
And that's the the big challenge that I think so many people have is because it's easy to just get down and stuck in the rut.
Mm-hmm.
But something's got to be the catalyst. I mean, I recommend anybody to read Goggins' Can't Hurt Me book.
Oh. You can't be down if you read that book. You just can't.
No,
you can't.
I think it was after reading that I signed up for my first half marathon.
Oh, really?
Yeah.
Okay.
Yeah. In 2017, I think was the first half marathon I did.
Yeah. Yeah. So that would have been San Antonio then. We probably did that one together. Yeah, we probably did that one. I was doing that one at the same time.
Yeah.
All right. So John, so if you were to wrap up, why? Because I know a lot of people are going to be like, John, what's the big deal about running? Why do you care? What's the ultra? Because people say, why did you do an Ironman? And if you just in your mind, what's pushing you to even do any of that stuff? Why?
It's the challenge. It's finding out what really are my limits. I mean, okay, I did my first half marathon and I was like, man, okay, that was cool. I could do that.
Yeah.
Then I did a marathon. Then now I'm running 13 miles every Sunday with 2 dogs.
Yeah.
Now I'm doing the 50Ks, and I'm going to do a 60K. I'm going to continue to push myself to find out really what are my limits. And it's the same thing with business too. I mean, okay, I was a very successful executive. I made it.
Yeah.
And then something inside of me said, I want more. And it's not monetarily wise. I mean, heck no. I mean, that's the first thing about starting your own business.
Yeah,
it's going to be rough for the first few years, right? But it's now I'm doing something for myself by myself.
Yeah,
and building upon that. And so, I got to say that it's pushing to see what your limits are, And I got to give props to my wife too, because there was nothing cooler than her and my daughter showing up for me at the finish line of my first 50K.
That's awesome.
Drink even found me around mile 19, right, of the San Antonio Marathon just the other weekend.
Oh,
so
that's cool.
So it's cool to be able to, she didn't want to she did not let me give her a kiss, I should say.
Nope.
I was sweaty and everything else, but I was
my wife would have said the same thing. You just stay over there.
Get away.
Yeah, exactly.
But see, then also having the support systems like that.
Oh yeah.
And then that's just okay, we're going to do this.
Yeah.
So it is absolutely, it's more than just a mental disease. It's the whole package. It's physical, mental, it's emotional. I would even say spiritual.
Oh yeah, big time.
To push yourself to new levels and decide, okay, this is, are we going to plateau here? Or are we going to keep going?
Yeah.
And part of me does really subscribe to, if you're not growing, you're dying.
Yeah. Yeah.
The day we stop and we slow down, I mean, that's why there's some really interesting and somewhat scary stats out there about the number of people that retire and then die soon afterwards.
Oh yeah. Yeah.
Right, because now they've quit. Right, what's their purpose? They stopped growing.
Yeah.
And the other part of that too is forcing yourself to overcome adversity.
Yeah.
Is the ultimate source of growth.
Yep. I just do hard crap. Do stuff that's hard, right? Whether that's getting to the cold plunge at Lifetime, which I hate. I hate getting in that stupid cold plunge. And I'm not like Gilly. I got a buddy, Gilly Mendoza, who stinking gets in there for like 5 minutes. I'm like, no, sir.
Right.
I'm getting in to get all this heat off my body from the sauna, and I'm getting out of there. Like I dip and I'm out. Right. I just got to stop the sweating. You know what I mean?
But it's doing something hard.
Do hard stuff.
It's hard and do it every day.
Yes, do hard stuff, Right. All right, so we got a new... you got one at chart?
I was got to... Here, let me run through these slides real
Please.
quick.
You got more?
Yeah.
All right, come on.
Okay, so this one, right? This chart here is, again, it's just showing you average mortgage rates over the course of the last year.
Oh, interesting.
And what you see here, right? 30-year conventional.
Yeah.
All right, that's 6.25.
Yeah.
And 30-year VA today, 5.9.
Wow.
So FHA and VA rates are in the 5s right now today.
Okay.
Let's go to the next one.
Okay.
This is what I was talking about. Rates drop, home buyers pop.
Yeah.
This is mortgage purchase applications, up 20% year over year.
Wow.
So these are people actually applying for a mortgage loan to buy a house.
Yeah.
And these are the things, right? I mean, the data does not lie, and when people can visualize it, they can see it.
Yeah.
So I want my realtor friends out there to see this and go, hey, this is 2026 is going to be the great rate reset, and it's going to be good for everybody.
Yeah.
All right,
Which
next
is good.
Okay, this is really interesting. This is outstanding mortgage rates of conventional loans that are still floating out there.
Okay.
And what you see here is, let's see, I actually wrote it down. 20% of all outstanding mortgages still are under 3%. So there's a lot of 2.75% mortgages out there.
20% of the mortgages.
Yes.
Okay.
Of outstanding mortgages. Now, Wall Street Journal even had an article that showed that there's even people getting divorced but cohabitating now because they don't want to give up their 3% mortgage.
Wow.
It's interesting. 32% of outstanding mortgages are between 3 and 4%, right? This is this number right here. 18% are between 4 and 5. 10% are between 5 and 6. 20% of now outstanding mortgages are over 6%. But
so that means 80%
of loans are below
6.
Yes, of outstanding mortgages today. Sheesh. But what I want to show you, though, right, is that the percentages here are shrinking between the 5 to 5.99, the 4 to 4.99, and to a certain degree, even under the 3s.
Yes.
So life is happening. People are still giving up these mortgages. Now, albeit, under 3%, that's shrinking a lot lower.
Yeah.
But there is but life still happens.
Yeah.
Death, divorce, disability, moving, just life.
New job.
So so nonetheless, this is just really fascinating for those to see it. And go to the next one.
Okay.
And it really kind of ties it together. So look at this. So this was 1 year ago, the percentage of mortgages under 3% and the percentages of mortgages over 6. So
Okay.
let me look. You still had a big spread there.
Yeah.
It was shrinking, but still a big spread. Go to the next one, and now look at that spread.
Oh, wow. They're converging.
Yes.
Yeah. Yeah.
So it's not out of the question to think that by the end of the year
yeah.
that there will be more mortgages out there over 6 than are under 3.
Oh, interesting.
So that's going to cross the Rubicon here, in rather short order. But either way, it's fascinating to me because again, it just proves that ultimately the mortgage rate lock effect, right? That's keeping inventory frozen. It's waning.
Yeah. Yeah.
All right, next one. Again, inventory. Inventory is the key to everything.
Yeah.
Right. I mean this is what dictates it. And as much as I hear some folks going, oh my God, inventory is there's too many houses for sale and not enough buyers, and there's a lot of those folks have been in the business for less than 5 years.
Yeah.
Because we're still not back to pre-COVID inventory levels. It's closer, but we're still not there yet.
Right.
So I mean the market is getting healthier. It's a lot better than it was. 2021. Look at that for sure.
Yeah.
But we're still getting better. I mean, even though we're 15% more inventory than we were this time last year. All right, next one. Let's see here. Oh, this is interesting too. The percentage of homes that are for sale that have had price reductions.
Oh, wow.
And you could see here, price cuts currently today, 40%. And
Have had a price cut.
Yeah, have had a price cut.
Okay. Got it.
And this is where I try to talk. I teach a class to realtors called "Sell Like a Builder."
Yeah. We did it together.
Yeah.
Tuesday. It's great.
Yes, no, and I've expanded on that. So go to the next one here.
Okay.
And here this is just kind of interesting, right? So people say, "Oh my God, look how many more sellers there are than buyers," and it's like, yeah, that's true. You do have a lot more sellers than buyers. But go to the next one. But are you really pricing that house for sale in the right way today or not?
Yeah. Yeah.
And what this shows us here, this data from the NAR, and it shows the price reduction from list to contract based on the days of market.
Okay.
And you can see 0 to 14 days still having a 5% price cut, all the way down to more than 120 days, and you get 10% price cut.
Yeah.
And so where I use that is to try to help people understand that if you're selling an existing home today, whether you're a seller or the listing agent on that, who's your number one competitor? Next slide. It's these guys.
The builders.
Home builders.
Yeah.
And this is just Lennar's based off of their third quarter. They're just one of the major ones. But look at this. They've now hit 14% average sales price is incentives.
Whoa.
I love it during COVID.
They're like, screw you.
No
We ain't getting
incentives for
nothing.
you. But now it's up to 14%.
Wow.
And you haven't seen levels like that going back to 2009.
Which makes sense because that was the last crash.
Yes, it was.
Yeah.
So they're trying to offload their inventory in rather short order as much as they can.
And they're paying for a lot of the loans too, aren't they?
They are absolutely doing it. And so that's why, instead of just, doing the little price cut, $5,000, $5,000, $5,000, $5,000, come in here and talk to the buyers. The home builders have gotten so good. They're not even selling homes anymore. They're selling rates.
Yeah. Yeah.
Right?
Which is smart.
They're selling a payment.
It's smart.
That's why we have 10-year car loans.
Yeah. Yeah. Right.
So and then of course this is just there to show again the key to overall wealth building generationally is through home ownership.
Yeah.
Right. And so this is, average net wealth for a household that owns a house, $400K versus renters, it's only $10K. Next, let's jump over to the next one here. This is what makes me also very bullish on housing though.
Okay.
This is the chart's from 2024, but you and I, we're kind of right here in this Gen Xer, right? I mean, look, we're like in the little bottom of this dip. But look at the millennial and Gen Zers coming up right behind us. There is a wave that's coming. And so even as people are...
Is population? Is that by
this
population?
is population here in the
US.
US.
Wow.
Yeah. So even as younger folks, say younger, Gen X, or millennials, Gen Zers, even though they're delaying major life purchases, like buying a house or even getting married or having kids, it's still coming.
Yeah.
I mean, that's not going to go away. So if you go to the next one here, and this just breaks it down and is a great visual, I think, for any real estate professional to look at it and go, okay, so currently there's 73 million millennials with a median age of 35 years old, right?
Yeah.
Their home ownership rate is 45%. But when millennials where at a median age of 30, they had a 10% home ownership rate. Or I'm sorry, they had a 33% home ownership rate.
Okay.
So now look at Gen Zers. Their median age is currently 20 years old.
Okay.
Their current home ownership rate is 8%. So if they're going to align with millennials, then that's saying over the next 10 years, their home ownership rate is going to increase from 8 to 33%.
Oh.
That's another 17 million homeowners.
Wow, across the U.S.
Across the U.S. So if you and now in San Antonio, we have
that's a lot.
We have a very young population here.
Yep.
So this is why I'm still very bullish on housing.
Yeah.
It's not going to go away anytime soon. And then I think we got one or maybe even two more. Education is key.
Yeah.
I mean, this one it's kind of scary. It's very sad. But if you look at this, black home ownership has actually reached its lowest point since 2021.
Wow. Yeah.
So, I go back to, for particularly for millennials, Gen Zers, financial literacy is the key. And we've got is real estate and housing professionals. Yes, we all want the luxury, serve the luxury market, and we do.
Yeah.
But it's also everybody. And we've got to do a better job with educating our communities.
Yeah.
And making sure they understand that the key to long-term wealth creation is through responsible home ownership.
Yeah.
So the sooner we can fix that, the sooner we can solve a lot of problems in our country.
One caveat, I don't know if you've heard this, but Grant really pushes against home ownership. And I've always heard him say that. And I've always asked, because I'm always curious. Yeah. And I've heard a couple of people ask him. His big push is being nimble, being able to make change, being able to move. Like if you need to move to another city, I get all that. But at the same time, there's like that cognitive dissonance where I'm just like, yeah, but
right,
the what I had in my last house I basically sold it. I went from 140 to 430. So massive equity over 13 years in that home, and I had the house paid off.
Right.
So that is a wealth builder. Yes. If you buy right and you live in it and you take care of it. And so there's part of that where I just kind of like I get it into some certain circumstance, and then on the other there's other sides of that coin where I'm like, I don't get that.
Yeah. Now,
keep in mind he owns 4 homes.
Right.
3 homes.
Exactly. Right. And if you dissect and you look at the top 1%, they all own multiple estates. And so I get it. If your target audience there is, younger folks that we're wanting to get them to invest, then then put money into this vehicle versus buying a house. I still disagree. I still go back to, really, okay, who makes up a majority of America? Yeah. Right. And then so and it's okay to subscribe to 98% of what somebody supports. Yeah. It's just like Dave Ramsey.
Oh yeah.
I love him. Except when he starts talking about home ownership and telling people to put 20% down. It's like, no, that doesn't do anybody any good. Yeah. So I disagree with Grant on that one too. Home ownership, responsible home ownership is a key to long-term wealth creation, but there's also supporting data that goes out there that shows that it's also better for a stronger family.
Oh yeah. Yeah.
More stability.
Yep.
Schools, continuity. So there's non-financial aspects that need to be applied.
Like the emotional aspect of it too. Yeah. Interesting. That was the last one? Yep. That's it. Yeah. That was the last one.
So there you go.
Well, man, I love this. I'm glad you brought these, and we'll make sure to put these in the slide so everybody could see them. We're going to end up on our last question of the day. Ooh. And this comes from, have you seen this podcast, by the way?
No, Diary of a CEO. No.
Diary of a CEO podcast. I'm fascinated by it. I'm going to send you one of the latest ones that I just did because I check my glucose and my ketones every morning now based on this podcast.
Really?
And I'm in ketosis right now.
Oh.
I'm typically, by this time in the day, I'm at about 1 to 1.3 ketones, roughly. So I'm not there's no sugar, 0 sugar. 0 carbs. If I eat carbs, it'll be the only time I eat carbs are at lunch, and it'll be like sweet potatoes or lentils, some kind of bean. And then at dinner, no carbs whatsoever, no sweets. I'm talking 0. I haven't had sugar since before Thanksgiving.
See, and you're talking to the ultra marathon guy that just
You like ice cream.
I was eating HEB Creamery ice cream last night.
I know.
So-
I know. But I will tell you the key to this is burning visceral fat.
Yeah.
Like this,
Yeah,
when
yeah.
you get into ketosis, like you did the fast with me. Did you ever do the
yeah.
fast?
No,
the 3 day or 4
right.
day?
Yeah, we did the fast. It was part of one of our book clubs.
Yeah. So that, like doing a fast, you know how you get to that point where you're like the energy's like,
Yeah.
and you're clear, like you can do that and eat. You can have that level of energy burn because you're
Okay.
burning just visceral
Yeah.
fat, and you could have that and still eat and enjoy your food and have like really good meals. Like I had a great meal here today for lunch that I brought for myself, and I just heated up and ate.
What'd
It was
you have?
chicken,
All right.
carrots, a little bit of broccolini,
Yep.
black beans, and sweet potatoes.
Okay.
And this with the air fried chicken.
Kind of making me hungry.
Yeah, bro, it's delicious. It's absolutely delicious. But if you want to know more, I can go down the rabbit hole. So pick 2 cards.
Ooh,
These are
cards.
2
All right.
different questions, and they're deep. All right.
All right.
So you're gonna pick the question, one of those 2, and then we both have to answer it. By the way, I got a really hard one the other day. Delane Matthews picked like the hardest one the other day. Oh my gosh, it was so tough. Great interview though. I think
man.
you need to know more about Delane.
Okay.
Yeah.
Okay, check this out. So, I mean, these are both good ones.
Okay. What you got?
Well, I've got, can you describe what winning means to you?
Ooh.
Or if you were on your deathbed and can leave only one lesson behind, what would it be? That is,
Woo.
I couldn't even.
I'm just gonna let you pick, man. It's all you, John. You get to pick. You get to pick.
Well, I think the more challenging one there, right, is if you're on your deathbed and can leave only one lesson behind, what would it be?
What would it be, John? Man, that's a good
Everything happens for a reason.
Okay.
And I'm not, not trying to set, any, hey, it happened for a reason. That's why, you're somebody backed into your car today. No, I think it's, the lesson would be you're going to face a tremendous amount of adversity in anything that you do.
Mm-hmm.
And kind of go back to, what you're talking about with the your Iron Man, and you just can't stop.
Yep.
You just got to keep going, right leg, left leg, one step at a time, and keep going. So my lesson, I think to myself, right, my lesson would be, I guess I suppose to my daughter, and that's going to be, there's going to be some bad shit that happens in your life.
Mm-hmm. Yep.
And take it. Don't let it be an excuse to give up. Don't let it be an excuse to not fulfill your own dreams, and don't let it change you. Or if it does change you, it changes you for the better.
Mm-hmm.
I think about all the struggles or challenges that I've had in my life growing up. I had a little brother pass away when I was 6. He was 5, drowned in our backyard.
Didn't know that.
I was the one that found him in the pool and tried pulling him out of the swim spa at our house.
Wow.
Folks got divorced. House, marriage ruined. I mean, it was a complete mess. And at the same time, my dad was in gas and oil, and this was in the early 80s. And, so you went from, I saw fortunes made and destroyed and disappear. And then even to, my mom's own passing, not long ago. So every negative thing that's happened in my life has made me better for it.
Mm-hmm.
And so that would be my lesson.
That's good.
Shit's gonna happen, and you're just gonna don't let it get you down.
Yeah. Yeah. Keep moving forward.
Yeah.
Woo. Okay, man. If
know.
I were on my deathbed, what lesson would I leave behind? What would be the big lesson? So I'm thinking, I'm obviously talking to my son, right? So
Yeah.
I'm talking to Enzo. I would say set big, crazy targets and goals for yourself, and don't be afraid to make them really unreasonable. right? I think I'm learning that at 50,
Yeah.
and I wish I would have learned it at like 12, right?
Yeah.
Because, I think if you learn that the early enough, if you learn to set big, crazy goals early enough and you write it down and you talk about it and this is what I'm going to do, this is what I'm going to do, and you're constantly moving in that direction, you don't let other people derail you because the target's so big, you don't have time to listen to the barking dog next to you because you're going somewhere. You got something. And I think when I was younger, I was always afraid to set big goals because I knew I had to do the work to go get it. So I didn't want to set a goal. Like I remember distinctly sitting with an agent and she's like, did you do your goals already for the next year or whatever? And I I just was like, I don't write goals like that. I don't do that. This was probably 9 years ago.
Oh, wow.
And I said, no, I'm not a goal thing like that. I've never done it. And she's like you got this magazine, you've been successful.
Yeah.
I said, I don't set goals like that. I've never really been a goal setter like that. And I remember going home and thinking, I know why I don't set goals. I know why.
Because you've already got it.
No.
Oh.
Because I didn't want to do the work to go get it.
Okay. Yeah. All right.
Right? And I didn't want to fail and say everybody, hey, I want to be an owner of the Spurs.
Oh, yeah.
And then have people, every year going, so how's that going with owning the Spurs?
Yeah.
Hey, I'm one step closer. I did this today. I had my first webinar.
Right.
I'm one step closer. I did this today. I wrote a page in my book, right? Like I'm one step closer because I had a podcast with John and we were talking about home ownership, right? So it's like I do, when you set big targets, you got big targets of people wanting to go, well, how are you going to do that?
Right.
And I didn't like that. I didn't want to have people know my business. Now, sometimes, there's some targets you want to keep to yourself. I know owning the Spurs is probably a target that's going to put a target on me just by saying it. But here's the reality. The reality is we all need a fuel that's going to push us to that next level.
100%.
And when you don't have targets, you have no fuel.
Yeah.
Targets give you fuel to move forward.
Awesome.
I think you should share. I have a couple questions from a Gen Zer.
Okay, yeah, that's great.
Questions from the audience.
Yeah,
I love it.
Okay, so for a lot of Gen Zers, owning a house is like later down the line.
That is a great question. So if people didn't hear it, right? The question is, okay, is it Gen Zer? I'm looking at, oh my gosh, buying a house is a lofty goal. Am I ever going to make it? Where do I start?
Yeah, and this is Jessie on our team with Luxury Home Magazine, and I'm so glad that she, she's throwing this question in there. I think it's great for the audience.
Yeah, TM3 overtime.
Overtime, I love it.
Yeah.
Yes.
So, well, first of all, and it's funny because I did actually write some stats down on this, and there's absolutely data to back it up. There was a study called, and I'll send it to you because it's fascinating reads, the Next Gen report, and it was a survey of over 1,000 millennials and Gen Zers, and 60%. See homeownership as attainable, which sounds great, 60%, awesome. But then you think, oh my gosh, there's 40% that go, man, I'm never going to own a house. So it's like, man, okay, so what do we do there? And this is interesting too, right? So 43% of millennials turn to a realtor first. 36% of Gen Zers start with a financial advisor. Interesting. I found that to be interesting.
Wow.
66% are using YouTube to educate on home ownership. 35% using ChatGPT. 40% of Gen Zers and overall using social media for buying a house. But where I would say to start is really not to sound self-serving here, but talk to a licensed and local mortgage professional that's going to sit down with you. I know there's a lot of great online platforms out there, and they do. They serve a purpose. But when you're buying your first house, there's a lot that can't be explained in a website portal.
Sure.
And, I like to have people come to my office, sit down. We've got 4 monitors, and I'm going to turn it around, and I'm going to help make you understand, okay, this is what a house payment is. Are you comfortable with this payment? What is the payment that, because there's lots of houses that you could afford, but should you? Mm-hmm. It's what is your lifestyle? These are all the questions that need to be discussed up front, so that way when you begin that process, that's where you start. There's also, for example, I mean, I had a young couple come in, referral from Craig Browning, first-time home buyers, and they're not mortgage ready. And there's nothing that stings me worse than having to tell somebody you're not mortgage ready. And because there was some
And give me some idea what that means, like for somebody that's not mortgage ready.
Like in this
debt to income.
Like in this case, no, the couple, they made great income, but their credit had left a lot. They needed a lot of credit work.
Okay,
a lot of credit work. And interestingly enough, primarily from student loans.
Oh, wow.
Yeah. Because people had to start making payments again on student loans. A lot of people didn't know that. And so now all these things are reporting late. And now the score is mush.
Yeah.
If that person had just gone to an online portal, they're just going to get, oh, sorry, we can't help you. But here, sitting down with a licensed local person, I'm able to I spent an hour and a half with them yesterday and walked them through the time frame that it's going to take to where, okay, do this, and this, and in 6 months, okay, now we're going to be ready.
Yeah.
So that would be my place to start. Debt to income ratios is the biggest challenge that I see first time home buyers struggling with for qualifying purposes.
Explain that so they fully understand that.
Debt to income ratio. So what we do is we qualify people based off of their minimum monthly liabilities, revolving debt, installment debt,
credit cards, cars,
credit cards, car payments, student loans.
Yep.
If there's, if do they pay child support? I mean, all payments in there. So we look at that. That's your just your monthly debt, and then we're going to divide that number by your gross monthly income.
Okay. So
this is whether you're salaried, if you're if you get bonuses or overtime, how long have you had that? Do you work a second job? These are all things that need to factor in because there's a lot of people that think they make more money than they do on paper. Yeah. They might cash flow more, but from a qualifying standpoint, we're not able to get them there.
Yeah.
And so again, so that's where the debt to income ratio is. And I might be able to get your loan approved at a 50%, right? Meaning your mortgage payment plus your minimum liabilities equals 50% of your gross income.
Wow.
Not take home.
Yeah.
So just because I can, should I?
Yeah.
And this is the moral dilemma. And it's something that I put back to the buyers. It's like, can you make this payment? Are you comfortable with this? Hey, okay, so your grandma's going to move in with you, and there's going to be extra money in there, or you're going to have roommates. Well, then now we can make it work. So, but again, so that would be just my best place to start is not necessarily going online per se, but sitting down, find a mortgage professional that you could sit down with.
Yep.
And take time. For what it's worth, I mean, as mortgage professionals, it is just like real estate professionals, it is a commission-based job.
Yeah.
We don't make a dime until that loan closes. But the way I see it is my time is well spent educating and helping people learn.
Yep.
Because, treat everybody with dignity and respect. That's going to come back to you tenfold. I'm just a firm believer in that. But that would be where I would say to start.
What percentage of them actually own homes? Like for your generation, what was the median age of them buying their first home versus the projections you're seeing for Gen Z?
Man, that's a great question. And I will have to. I could get the data for you, and I will. So don't quote me on this, but when you look at the average age of a first-time home buyer. And you could see that today, the average age of a first-time home buyer is now 40.
Are you serious?
Yeah. Oh, yeah. Now, keep in mind,
wow,
that statistic is also skewed because last year we had 21% of all real estate transactions were first-time home buyers. So that which was the lowest level of first-time home buyers we've seen in ever.
Okay.
But nonetheless, it's still 40.
Yeah.
Where, if you go back to the 80s, right? So even, our, parents' generation, that first-time homebuyer age was more like 26. So it has steadily increased over the years. And again, I think in post-COVID, everything's just being delayed. And so people are having kids later. People are getting married later. People are buying their houses later. So it is absolutely a factor. But yeah, it's the younger generations are waiting longer in general. But I mean, I can tell you that anecdotally speaking, I mean, a lot of the inquiries that I've had recently are younger folks.
Okay.
So
That's good.
That gives me hope. I bought my first house when I was 23.
Yeah.
Barely knew that there was a T in mortgage. I say that I was working at a mortgage company at the time, but I didn't know what I was doing.
Right.
And interestingly enough, I could not afford a house by myself, so I bought a house with a buddy of mine.
Oh wow.
So yeah, so we were roommates.
Yeah.
Ironically enough, I mean, we lived in the same apartment building at the time, and then we bought a house together.
Yeah.
And so, and interesting enough, there's data in this report that I'll send out to you guys. Gen Zers are more likely now to purchase with a friend than any other generation previously.
Well, they probably don't really have a choice, unfortunately. I think that's part of it.
It is that, because now you get dual incomes without having to be married,
right?
right, to help qualify for a house,
right?
So I can't tell you what the average age is, but that data is available, so I can get that. But it is interesting. Yeah.
We're talking about responsible home ownership.
Yes.
And like making the most out of your purchase. Like, what does that mean? Does that just mean like making your payments on time? Like, what is?
When I say responsible home ownership, we've heard that we've all heard of the term house poor, right? Where it's like, okay, I've got this house, but I've got the pizza box furniture, so. Yeah. I want to make sure when I say responsible is not getting you in there after you pay your bills that you still have some money left over to eat, right? And that would be the extreme, but and again, it just goes back to just because you can, should you?
Yeah.
And so I'd say, look, and this goes back to why I think anybody buying a house needs to start with a mortgage professional first, because it's so easy now to just go to Zillow and fall in love with the $400,000 house that you see on there, which the Zillow calculator is bullshit, by the way. Sorry for the language there, but it gives me I can get passionate about this because it gives people false hopes and false payments in their mind.
Oh, no.
And then they come to qualify, and that $400,000 house that they fell in love with through the pictures is now $275. Because that's the payment range that they can really afford.
Oh, gotcha.
Right.
Yeah.
So
it's showing a price that's not valid.
It's showing the payment is not accurate. It's not a real portrayal for what a consumer is looking at.
Yeah.
And so it's like, okay, responsible homeownership, finding a house that you're comfortable with, that you can make your payments on and still live comfortably and still pay for the light bill, and be able to take your kid to Mr. Gaddy's, whatever.
Well, the biggest thing too, I'll say with that, Jesse, is like, I think, you want to also be able to, because when you own a house, there's certain things that you got to do. And it's the maintenance piece.
Oh, yeah.
That a lot of people forget about, right? It's the HOA fee or the trash fee or the electric fee, and some of those things you have when you have an apartment, but it's not it's not the same, right? It's a little different. And so you have to factor that in, and then the big thing is taxes, right? Like, that's why I'm hoping this DeSantis thing passes in Florida, because the minute they pass that, it's coming to Texas.
Yeah.
Like almost instantaneously, we're going to be voting on that.
Yep.
But all that to say is, people don't factor that in when they're looking at the payment, and you got to factor in that you got to factor in those taxes. You got to factor in the maintenance piece to it, and then have money left over if something breaks.
Yeah, 100%. So, I'm a big advocate for utilizing down payment assistance programs. Right. I mean, I'm actually one of 4 loan officers in the state that's been approved through TSHAC to help the Kerrville flood victims.
Wow.
With a huge grant program. Yeah, we're helping a family get a grant for $140,000 to apply for buying a new home.
Man, that's awesome.
No, super cool. Which, I mean, they had where they lived was washed away.
Yeah.
So, but either way, coming back. So just what Tomas was saying, right? Having a little money left over in the bank. So the big challenge that I see a lot of people have, particularly younger generations, is, man, inflation's kicked the younger generations in the rear end. It's hard to save money. So if you've worked really hard and you saved up $15,000, if you go to buy a house, that might use up all of your $15,000. And now, okay, cool, you got the house, but you have no money left over.
Yep.
So that's why I'm saying, you know what? Well, hey, let's utilize the down payment assistance program. And now you get the house. You're using the state's money to help you get in. And now you closed. You still have $15,000 sitting in the bank that's yours.
Yep.
And to me, I would rather do that loan all day long versus do the loan for somebody that's, okay, yeah, skin in the game. Well, right, but now they have no money left over.
Yeah.
So I don't like the skin in the game argument. It's can they afford the payment, and do they have money left over after closing?
You got to have some money left over.
Yeah.
Just to be prepared, for sure.
Right.
For sure.
But again, like I said, it is the key to long-term wealth creation, and the data is out there and it supports it. If you just look at that one chart that showed renters, 10,000 net wealth versus homeowners right at 400,000. I mean, it's almost overnight. And for many folks, when you really break down the data, and you look at particularly in the 50th percentile of America, that is the biggest source of family net wealth.
Is their home.
And when you get into the lower 10%, the gap between moving from the lower 10% to the 50th percentile is renting versus owning.
Yeah.
So
it changes it.
It really is. And philosophically thinking, the issues we have in our country, it's not R's and D's, it's haves versus have-nots. And the best way that I see that we could, create equilibrium is to help promote responsible homeownership.
Yeah.
And get people more in there.
And then figure out the supply with the builders. Figure out how to get
them to build more affordable
supply. Build more affordable. Right. Yeah. Well, John, that was awesome. I think that was great, Jesse.
Love overtime.
I think it's great. And here's the thing. I think this needs to be one of your videos. Right? Like, what if he started doing videos just on that alone? What millennial, like, what would you call it? Like Gen Z. Turning Gen Zs into homeowners. Yeah, like
we're gonna play with that.
And I think it'd be a great idea, right? Like, Gen Z, send in your questions about home ownership that you think that you wanted to know, and just that. Just doing a video on responsible home ownership. What does that look like?
Yeah.
Right.
Oh, that's a great idea.
That'd be powerful. So thank you, John.
Yes,
once again, thank you, Jesse, for those questions. That's awesome. John, have a great week. We'll see you, buddy. Yeah.